Welcome everybody. Welcome to Analysing the Big Four Banks. My name's Russell Markham. I'm the Director of Education for VectorVest Australia. And what a pleasure it is to have you along today. I know you're going to get a lot out of this. So here I am, and 11 o'clock Sydney time equivalent, we begin. So this is that time now. If you're watching the recording, don't worry, you can always still send questions to us, and we'll give you our details there at the end today. All right, so with that said, let's get into it. Just before we begin here, first thing first that I need to do, I need to make sure that I read the disclaimer statement. So please note our license there, and you can refer further to us per our financial services guide there per our webpage. In addition, any advice is general advice today. Please do speak to your financial advisor for personal financial advice. I'm licensed for general advice only. Past performance is not a guarantee of future results. Forecasts and back tests are used or discussed in this presentation are intended as a guide only, and actual results may be affected by known or unknown risks and uncertainties and therefore may differ materially from the results ultimately achieved. Okay, with that said, let's jump into it. The first thing I thought I'd do here is just do a bit of a snapshot in terms of what's happening with our big four banks across Australia. There's plenty of news items, and I had to be selective on some of the news items I was going to share with you. And we'll go through those, and then we'll use the power of VectorVest to really take a closer look at the banks. How about that? Okay, so let's move myself out of the way here, and let's bring that up there for you. All right, so first thing first, what I wanted to bring up here for you, and that is, let's just move this over the correct web page here. There we go. I'll bring this over here. All right, so the first thing I want to bring your attention to here is this one here. It was on abc.net.au. Australia's big four banks, ANZ, CBA, NAB and Westpac, now holding a whopping 1.87 trillion in home loans. All right, throughout 2021, as Australia's house prices skyrocketed, Australia kept on taking bigger mortgages, many worth more than 6 times their income, pushing up the profits of the big four banks. So it's big business for them to effectively, take on those mortgages. And anyway, it goes on to note over here, Ernst & Young found that 2.9 trillion of loan book held by the big four, including home loans, personal loans, business loans. About 1.87 trillion is made up of home loans. So 1.87 out of the 2.9 trillion in loans. In the year to March 2022, Ernst & Young says that the home loans written by the big four grew 2.4% to by 43.9 billion. Anyway, so it's fair to say you can see that there's a lot going on with all these mortgages being taken out. So where does that leave us? Because there's been news items there saying, be careful, with interest rates now going up, there'll be plenty of home loaners that'll be stretched, things could be difficult. And sure, that might be the case, but our take here, per this presentation here, is I don't think there's an issue until there's big unemployment problems. And at the moment, we're crying out for workers. So there's certainly the income there at the moment from jobs. People are finding employment. It's when unemployment starts to kick in that could become a problem. So let's explore a bit further. All right, next one here from the Fin Review. And this one noted here, why banks want higher interest rates and it's not what you think. Anyway, cut a long story short, if I go along here, the banks effectively, by the official cash rate being lifted up, they pass it on very quickly. You notice that? As soon as there's an official cash rate increase, so we had 0.3, what was it? We went from 0.15 and what are we up to now? 0.35 just the other day. So we had an uplift there. Going up there, we're still below 0.5 at the moment, but we're climbing up quickly. And with the latest rate passed on, what did the banks do? They didn't muck around, did they? They passed it on very quickly. Okay, so anyway, you can go on and read more about that, but why do they want that? Well, because it effectively sets the benchmark rate from which the lending takes place, right? And they've effectively secured cheaper lending, hopefully. That's what the banks are in business to do, secure it more cheaply. As soon as the official cash rates start kicking in, they can lend it at a higher rate and benefit profit-wise. So just over here, the RBA had little choice but to lift the cash rate percentage points to 0.35%. All right, so we had a 0.35 lift just the other day. Okay, so do banks make money when interest rates go up? Yes, they do make more money when interest rates go higher, but not in the way that you may think. The profits don't go up simply because you are paying a higher amount of interest as a result of the interest rates. A bank is in the spread business, that is, the profit margin is the difference between the cost of borrowing the money, mainly via the deposit savings of Australian households and businesses, and lending in the form of mortgages and corporate loans. All right, so cut a long story short, higher interest rates are actually going to benefit the bank's profitability. I guess that's the key theme we're bringing across. Let's go and have a look at the CEO here, Matt there. And you can see that Matt Coman, is ever pronounced his name correctly there, Australian Commonwealth Bank Australia. Matt Coman says homeowners may be worrying unnecessarily about the pace of interest rate rises over the next 12 months because he has confidence in the bank's forecast that the cash rate will rise only half the level predicted by the market. All right, so it goes on to note that maybe the concerns over inflation and the rising of interest rates are not going to impact as heavily. Why is this important in regards to the banks? The reason being is, of course, if there's concern about rising interest rates, some borrowers could default. There could be some issues, which in turn could impact upon the banks. But we know that higher interest rates help bank profits. So there's a bit of a balancing act here. You know, which narrative do you believe? Which one are you more concerned about as a bank investor? Do you believe in the narrative that interest rates will go up at a nice rate, not too high, and the banks benefit? Or are you concerned that they go up too high and start impacting upon bank profits? So I think it's fair to say that, you know, doesn't surprise me that some of these statements have come out to say, well, hang on, they're not going to go up as high as what one thinks. Right, just one viewpoint. Let's move on a bit more. Another one here from Investopedia. How interest rates changes effective profitability of banks. The banking sector's profitability increases with interest rate hikes. Institutions in the banking sector, such as retail banks, commercial banks, and investment banks, insurance companies, and brokerages, have massive cash holdings due to customer balances and business activity. So a lot of cash in the system, and higher interest rates mean that they can make larger profits by lending it out at a higher rate. There's a lot more to it, but again, I just want to show you another source there noting the relationship between interest rates and bank profitability. Moving on our journey, just to take a quick snapshot in terms of what's going on. So ASIC is going after ANZ at the moment. And in a statement, the corporate regulator alleges that between May 2016 and November 2018, about 165,000 ANZ customers were charged cash advance fees and the interest for withdrawing transfer money from the credit card accounts based on an incorrect account balance. So basically, they were taking too many fees. You know, let's have a look more closely at ANZ. Is that going to impact on their profitability? Let's have a look here. 3 of the big 4 banks pass on official rate rise to savers. Surprise, surprise. So the official cash rate lifting up, 0.35 just the other day. Notice how quickly the banks are at passing on those official cash rate rises. There are some commentators out there that have pointed out the banks are quick to pass on the rate rises to you, the borrower, and the mortgage, for those with the mortgage, but they are a lot slower at passing it on to term deposits. So if you're investing with a bank, it's a lot slower to pass that on. So hence another way they make profits. ANZ half-yearly profit jumps. ASX loses ground after Wall Street makes modest gains. So this was just the other day, 4th of May. So in spite of what's going on with ANZ and the regulator at the moment, look at that. ANZ's half-year net profit rose 20% to 3.5 billion, paying a half-year dividend of 72 cents. So just more background on it there. Let's have a look here. Another one I found very interesting. Big 4 Aussie banks steadily becoming big 1+3. All right, and we'll show you what we mean by that. Basically, ANZ is neck on neck with Macquarie in terms of its total market size. So Commonwealth Bank seems to be slowly but surely drawing away from NAB, Westpac, and ANZ. Each of which seems powerless to close that widening gap. All right, so it's not just about market capitalization, it's about customer base in this example here. After its third quarter update on Thursday, so this article was written there 16th of May, so hot off the press. After its third quarter update on Thursday, CBA is heading for a full year earnings of more than $9.5 billion, right? That was after reporting a solid but steady quarterly cash result of $2.4 billion, unaudited for the 3 months to March. All right, so just want to show you some further background there. So CBA really seems to be leading the pack at the moment, based on this article here, and you can research up more about it. Just a big picture again. Let's see, NAB joins buy now, pay later. All right, so we can see a lot of those buy now, pay laters, they haven't been all that profitable in recent months. They started with a whiz and a bang and they've kind of come off a bit, but a lot of commentators are saying it is the way of the future. So NAB has announced it will launch buy now, pay later in July. So let's just see what happens to its share price as a result. Is this going to help drive those profits? And the last one I want to share with you here, Big Four banks profits tipped to hit over 11 billion as rate hikes loom. So yet again, another article saying rising interest rates are good for the bank's profitability. Big Four banks are expected to report over 11 billion in profits in the coming weeks, and investors are betting high interest rates will further boost earnings as the era of ultra cheap debt has come to an end. The impact of rising interest rates on banks will take centre stage this week. ANZ, NAB, Macquarie Group kick off a round of bank profit results. Okay, so plenty going on here. Now, before I drill into the finer details of the banks, what I want to do here, so I want to show you something very interesting. So I'm going to jump into VectorVest here. And what I'm going to do here is I'm going to go down to this tool here called Events Viewer. So Events Viewer in VectorVest here, it's a wonderful tool if you're new to VectorVest. And what it allows me to do is it allows me to go and look up a watch list, for example. I've created a list of the big four banks. Actually 5, I've thrown in Macquarie Group there as well. And all I've said to VectorVest is tell me when the earnings are going to come out. When are the earnings due? Like scan the horizon for me. Tell me when it's going to take place. So right now on our radar at the moment, the next one coming out will be CBA, and that is scheduled to be 10 August. There's no guarantee they can bring it earlier if they wish, but right now I can see on the horizon all the other earnings have come out, or at least have been, and we've got CBA in August, so that's not that far away. So if you hold CBA, just be aware that early August is when it'll come out with its earnings reports. The reason why I like to keep a lookout on this if I'm holding the banks is because I can then decide, is it worth holding on to my given banking stocks when earnings season comes out, or am I better off just to wait on the side and see what the earnings report is? The danger with hanging on to a bank stock when earnings comes out is that the earnings may disappoint, and we know what happens to share prices with disappointing earnings reports. They get punished. This environment at the moment is in no mood for putting up with mediocrity. On the flip side, if the earnings report surprises to the upside, or it's better than what analyst expectations were, then you've seen what happens. Typically, those stocks tend to surge up very nicely, in this case, that being the banking stock. So at the moment, we're sort of in the clear apart from what I can see at the moment. CBA, just to be aware, it's in August. Okay, so let's go into watch list viewer here. So in VectorVest, we've got this wonderful tool that allows us to build some watch lists. Don't get bogged down by the functionality. It's pretty easy to do. What I'm wanting to share with you now is I'm wanting to show you, let's have a closer look at our banks. And what I'll do here, this is the beauty of VectorVest, I can make my screen stand out a bit more. All right, so I'm just going to make it jump out slightly here, just a little bit bigger, because it might just be a wee bit small on your screens viewing today. And in fact, let's just make it jump out just a tad more. All right, so we're going to drill into the banks. And so let's do this. There we go. And push on OK. Okay. So what I've done here is I've built a watch list of all the given stocks. And see here a few of you saying the viewing size of the screen at your end, only seeing part of the screen here. So give me a sec here. Let's just, I'll just blow the screen up just a bit more so you guys can see it. You haven't missed anything yet because we've effectively just gone through the internet article. So give me a sec, and thanks for the feedback there on the discussion there. Let me do this. You tell me if you like the size of this. All right, so we'll keep the changes here. Here we are. All right. I think that should be a lot cleaner. All right, so let us know there in the chat box if that's looking a bit easier for you. All right, so it should be a lot easier, bigger to see on your screens, and hopefully there it's a lot easier for you to see. All right, with that said, let's get into the analysis there on the bank. So I've only included the big five. All right, I haven't seen a comment there. One of you there was noting to me, let's see here, how does Bank of Queensland hold up against these big four? We'll bring in, how about that? Don't let me forget, we'll bring in Bank of Queensland at the end. How about that? Okay, so here we are. Here are banks, and the reason why I've put these ones in, I'll scroll across to the market capitalization. So we've got all these wonderful indicators in VectorVest. You don't need to use them all. They're there if you want them. For argument's sake today, I'm going to sort by market capitalization. All right, so I've just sorted on market cap. So your biggest one there is CBA. This is in millions, 181,000 million. National Australia Bank at 102, 84 at Westpac, and then look at this. Macquarie and ANZ are neck on neck. All right. Now there was a time there, a couple of weeks back, where ANZ was above Macquarie, and then it's reverted. So these two are sort of interchanging quite a bit. So when we refer to a big four now, dare I say it, as of time of presentation going live here on YouTube today, Macquarie Group is effectively your fourth biggest bank. It's just pipping ANZ at the moment, just. All right, so effectively you could say our big four includes ANZ / Macquarie. All right, so our big four effectively is our big five. Our big five is effectively our big four because these two are neck and neck. All right, coming back over here, let's begin the analysis. So the first thing I like to do when I look at the banks, apart from reading the news items, although they're useful, this tool that I'm going to show you here in VectorVest is infinitely more useful. All right, it cuts to the chase. So I'm going to pull this back 5 years, and I'm going to show you a very useful indicator in VectorVest. It's called EPS, earnings per share. It's a 12-month leading forecast on earnings. All right, 12-month leading forecast on earnings. So it takes into account historic, current, and then builds on the forecasted earnings. There are a lot of articles out there that I've shared with you from different news sources, Fin Review and ABC and a few others, that were talking about this very issue here, or this very undertaking, that earnings are going well at the moment. And the reason why they're going well is partly due to the fact that interest rates are rising. Well, we're seeing this, aren't we? So we're seeing that turnaround in earnings. Now, there's a strong correlation that we've seen over the years, time and time again. Rising earnings leads to a rising share price. All right, it's just common sense, I guess, when you think about it, because if I said to you, what would you prefer? Would you prefer to buy into a company that has falling earnings or rising earnings? Well, I want a company that's growing its earnings, all right? And then if I said to you, what do you think a company with rising earnings is going to do? Do you think it's going to do well, or do you think it's going to do badly? Well, if rising earnings are rising, it must mean it's going to do well, right? The next question I'll then put to you is to say, okay, if a company has a rising set of earnings, what do you think it's going to do to its dividends? Do you think the dividends are going to fall or they're going to rise? Makes sense. Companies making more money, they're more likely to pay out more dividends, right? So no matter what type of share you're looking for, if you're after dividend companies, then why not consider companies that are growing their earnings? Because companies that are growing their earnings are more likely to be companies to meet or exceed dividends. Now, let's cut to the chase, because a lot of us hold the banks for their dividends. I think it's fair to say in Australia, that's a fair comment. They are some of the best dividend-paying companies in the world, not just in Australia, globally. And then, of course, we also get the upside benefit of franking credits. So the franking credits turbocharge and give us a little bit of extra as well, don't they? All right, so with that said, let's have a look. CBA. Wow, look at the turnaround in the earnings here. It's no surprises to see the share price gone from 60 to over 100 bucks. Big turnaround in the earnings. All right, next one here. NAB. Yeah, great set of turnaround here. It's gone from 15, 16 odd bucks to over 30. Wow. There it is. That correlation between earnings, it should not surprise existing subscribers, and hopefully for those of you that are new to looking at VectorVest, hopefully this is a eureka moment going, oh, I've never looked at shares like this before. There it is. That's what drives it. All right. Westpac Bank, not as strong as the others. All right, so I know there's different analyst takes out there, and I'm not going to get into a debate as to who's right or wrong. I'm just using what I'm seeing here with VectorVest. I'm seeing a turnaround in the earnings, but it's not nearly as powerful as the other two. All right, it's a bit more anemic, but nonetheless, it's a turnaround. Nonetheless, it's gone from $15 to $24. I'm not as excited with Westpac compared to the others, but that's just me. All right, Macquarie Group. Now, I just can't fault Macquarie on its earnings, and it's not just over the last 5 years. If I pull it over, let's say, the last 10 years, and again, I can't give you advice. I can only speak from a general advice perspective, but from a general advice perspective, I like Macquarie's earnings the most of all the banks, period. But that's me. All right, that's my opinion. Its earnings have been some of the best over the years, and look at that share price. All right, it's no surprises to see it's caught up with ANZ. All right, moving on. ANZ, big turnaround there in the earnings, so well done to the team. They've turned things around, and it's a pretty powerful set of turnaround in the earnings, despite the regulator going after them for a breach there. But they're doing a good job growing those earnings, so they're really starting to turn things around. They were under quite a bit of pressure. I remember during the height of the property sort of boom, they were just not getting mortgages approved as quickly as what they'd like, and they'd worked pretty hard to turn things around. So, there's good things going on there. All right, let's go back up to the top of the list again. Let's do this now. So we've established the pattern on earnings. I'm going to do this. I'm going to bring in dividends. Let's bring in the yield. All right, so I'll just change the style. Let's make this jump out a lot more. All right, so here's the yield. So it's just simply the dividends paid divided by the share price times 100. All right. So what are you getting as a return on the current share price? I'm not too concerned about the trend as such, as long as it's within a reasonable number. It's more the number. I can see at the moment that CBA, if I bring up the exact figure there, what's it, dividend yield's about, current share price, it's doing about 3.52, just shy of 4%. It is also fully franked. Right, franking credits 100%, interim and final franking credits at 100%. So it's fully franked, paying about 3.5%, and you mark it up. What's that? It would be 3.5 divided by roughly 0.7. You're getting close to about 5% fully franked dividend yield. Now, if you're after the exact dollars and cents for dividends, then you can see there it is, about 3.75, give or take. All right, so we're calculating that through every day there for you. Now, a few of you will know exactly what it is, and when the interim and final franking credits take place, we can do that in VectorVest as well. So we can put on our dividends. All right, so that's div X date, and that's when it's paid. Div X date when it's paid. So the last div X date took place there, 14th of Feb, and you're feeling pretty good as of 28th of March. You got yourself a nice juicy dividend. Prior to that, the div X date was 16 August and the payout was 27 September. So it looks like about twice a year. You get an interim and a final. Again, I don't want to get into too much theory here, but if you're buying a company like CBA and wanting to get the juicy dividend on offer, if you buy it on div X date, there's the div X date, you're not going to get the payout. It needs to be at least 1 day prior. All right, so you need to make sure that you buy it 1 day prior. Don't buy it on div X date expecting to get the dividend payout. All right, so it's just a small thing to be aware of. And again, I can't give you advice. That's just general knowledge from an investment perspective. And the other thing too is your franking credits. There is a certain time period from which you need to hold your share in order to get the franking credits. 40 odd days. I'm not going to give you the exact numbers there. Speak to your financial advisor. Each person may differ accordingly, but just some things just for you to be aware of as well. Okay, so let's do this. So we're just concentrating on the yield, and let's do this. I'll show you the correlation between div and the earnings. So let's do this. This will be quite interesting to show you guys this. I actually really like this exercise. All right, so let's do this. Notice the correlation here. Rising earnings, rising dividends paid. All right, so we can see that the yield is coming in at a nice 3.52 currently. Okay, let's keep going. NAB, rising earnings, look how the dividends lift up, right? Falling earnings, look how the dividends taper back. It's just common sense from let's pretend you're the CFO of a company. A few of you in attendance may very well be a CFO, a chief financial officer, but let's say you're controlling the purse strings of one of the big banks, right? So you paid your big grand salary, no doubt, and you've got a high-powered, stressful job, right? If you're the CFO of one of these big banks and your earnings are falling, and you meeting up with the CEO and the board of directors, and they're saying, what dividend strategy should we have for our shareholders? We've got pretty demanding shareholders. They expect us to deliver, right? Because a lot of us hold those banks and expect the banks to deliver. I'm certainly a demanding shareholder. I expect my dividends. But as a CFO, you're saying, whoa, hang on. If we're under earnings pressure here, we better not hand out too much of our dividends. We've just got to be careful, right? We've got to be prudent. So you as a shareholder on the flip side, why not pick up those high dividend paying companies when the earnings are going up? So you can see there's that correlation, what I'm talking about. The earnings coming up, the dividends increasing. All right, so good story for NAB. Westpac Bank, remember, noted it's more anemic on its turnaround in the earnings. Not bad, but it's not as good as the others. And you can see the dividend uplift has not been as impressive. It's gone, well, in fairness, gone from 31 cents up to, what's that, about $1.18. Well, maybe I'm being a bit unfair. That's a pretty impressive uplift. But here, where the earnings start turning around, dividends for NAB at 60 cents. And now they're at $1.40. Well, in fairness, I think Westpac is on par, but I'm not expecting it to be as grand potentially as the others unless those earnings continue to power up higher. All right, keep moving on a bit more. Macquarie Group, well, we've seen stellar earnings from Macquarie over the years, and it just doesn't surprise me in the slightest to see those dividends just continuing to power on. So 369, and they've pretty much almost doubled their dividends as well. All right, so there's Macquarie, and here's ANZ. Earnings turning around quite nicely. ANZ they haven't lifted it up as quickly. And well, in fairness, they have doubled it. All right, it is a smaller amount, so don't get caught up by the actual dollars and cents, because you see, I'm looking at this saying, well, it doesn't look as impressive as the others. That's where your yield comes into play. All right, so what is it as a percentage of the share price? So let's go back and just check our yields again. As the share price goes up, unless the dividends keep up, then the yield's going to be impacted. All right, so it makes sense because it's divided by the share price times 100. So the share price rocketing up nicely, but in fairness, well done to CBA, because they have kept the yield pretty much consistent, close to that 4%, and they've had to increase their dividends as a result. All right, so you see that correlation there. So NAB, right? They all seem to between that 4 and 5%. I guess it's a politically important level for a lot of shareholders, right? See that? They're all keeping it between that 4 to 5%. All right, so in terms of the most impressive ones there, if I bring it back to table form and scroll my eye across the dividend yield, let's just do this for a second here. Dividend yield 3.5, 4.45, 3.87, 5.59. So ANZ is your slightly higher one there. All right. The other thing I want to point out here is all of these are fully franked, both from an interim and a final franking perspective, apart from Macquarie Group. So just be aware of that. Your 3.87 is not as impressive because it's not fully franked, so it's not going to be as high. So Macquarie Group is your weakest link from a dividend perspective. However, Macquarie Group is your strongest performer from a 5-year price perspective. So let me demonstrate this. So let's do this. I'm going to graph the first one here. And what I'm going to do in VectorVest is I'm going to use this wonderful tool called Performance. It allows me to benchmark. All right. So if I've got CBA, I can put in MQG. Let's just put them in. I've got NAB, ANZ, and Westpac Bank, for example. All right. So here they all go in. Here they all are. And I'll just make these jump out just a tad more, just for demonstration purposes here, just to make it look a little bit easier on the eyes. All right. So hopefully you can see this a little bit easier. And what I'm doing here is I'm benchmarking these. So I'm going to tell you how they have performed against each other. Now, just in the chat box, for you in attendance here live, if you're watching the recording, don't worry about it, because it would have passed. But in the chat box, who do you think is the 5-year champion? I've already sort of given away the answer, haven't I, before? But who do you think is the best performer over the 5 years? Well, let's do it. Let's show you. See if you can beat me to it. Anyone on the chat box, just takes a few seconds for VectorVest to calibrate. A lot of calculations going in here. Who do you think? All right, well, if you said Macquarie Group, you're the winner. All right, right? Correct. Look at that. Over a 5-year time horizon, Macquarie Group has way outperformed. So all of them starting at a common base of 0, right? And then how they perform relative to each other. Macquarie Group has outperformed all of the others. In second spot over the last 5 years has been CBA. All right, followed by NAB, followed by ANZ, and Westpac Bank has been the laggard relative to the other 4. All right, let's do this. Put a bit more calculations onto VectorVest here. It'll take a couple of seconds here. Who wants to take a guess as to the 10-year? Any 10-year one here? All right, if you said Macquarie Group, bingo, you're spot on again. All right, so bingo, spot on. Macquarie Group has been your performer, and followed by CBA. And then right down at the bottom there again, Westpac Bank followed with ANZ pretty much neck on neck in terms of the performance, and NAB sort of just slightly above. All right. Well, historically it's interesting, it's useful, but what about now? It's all very well telling me what's happened in the past. What about now? What about now? Any guesses as to who's been the top performer over the last 6 months? Any takers on the last 6 months? All right, let's do this. Let's bring it in to 6 months. Here we go. All right, so look at that. Westpac Bank, it's the one that's been the laggard in the past, is right up at the top. NAB. You can see here that Macquarie Group's actually been under a fair bit of pressure over the last 6 months. All right, so you can see that Macquarie Group, ANZ are down negative 4 to 5%. Yet the other ones here are up anywhere between 10 to 18 odd percent. All right, so just interesting to see. And then over the last 3 months, you can see CBA has been the top performer, followed by NAB. All right, so just interesting benchmarking. But the overall story at the moment is that I'm seeing a lot of upside based on the earnings. All right, so we come back in here. This is all of the banks now. So this is the sum total of all the banks. All I've done here is I've just grabbed the average of all of these. And let's look at the overall health of the entire banking top 5. All right. Big turnaround in the earnings on the banks, as we're seeing. So big uplift in the prices moving. The yield, dividend yield there, gone from 2.67 as earnings were turning around to over 4%. So, makes sense that the banks cut their dividends as the earnings are under pressure, and then start lifting them back up as earnings turn around. So let's put in the dividends in dollars and cents. So you can see, let's make this stand out a bit more. It's a bit hard to see. All right. So you can see here, as the earnings start turning around, you can see how they've really started to drive those up. Okay. I'm going to do another exercise now, and I'm going to show you the sales taking place across the banks in addition to their net profit margins. Now we know, remember, based on the early earlier in the presentation on the articles I was referring to, their higher interest rates help drive the profits in the bank. So we're expecting their net profit margins to increase. So if you're wondering what this word net profit margin is, it's basically for every $1 of sales, how much money does a bank, in this case, or a company, keep in profit after all their expenses. So if I ran a coffee shop, for example, and I said, look, for every 1 cup of coffee, let's say I sold it for $1, I wish, but let's say you could buy a cup of coffee for $1. For every 1 coffee that I sell for $1, what do I keep in dollars and cents? And if you said to me, you know, I make 20 cents profit for every $1 of coffee, I have to pay my wages, my electricity, all the costs associated with running my coffee shop, I keep 20 cents. Well, then my net profit margin is 20%, right? So for every $1 of sales, I keep 20 cents in the dollar. Let's do the same now for the banks. All right, so with rising interest rates, we're expecting the net profit margins to increase. Let's see if that's the case. All right, so let's do this. Let's turn all this off. Let's put on net profit margin. I'll put this on across the banks and then we'll drill in. Wow, look at this. Across the banks, the net profit margin's rocketing up. Look at that. It's gone from 27%, 27 cents in the dollar to what's that now? 43. So you can see the big turnaround in those net profit margins driven by those rising earnings. Let's drill into the individual components, right? So we'll look at the individual banks now. Let's do this. And what I've done for this presentation here today is I've just created a layout for the banks just to speed things up. Don't worry, it's information overload here. I'm just doing this because this allows me not to have to do it on the spot here. Okay, so you're ready for it? Let's pull it back a couple of months, couple of years there. CBA. Let's look at CBA, the first cab off the rank. This is impressive. All right, CBA has an impressive profit margin here. You can see here on the net profit margin for every $1 of sales, they are making about 30 cents in the dollar. All right, so that's their current NPM, net profit margin. And you can see how it's really turned around, from 20-odd% right up now to over 30%. So that's impressive. Hence the uplift in their share price and the likes. Net profit margin here, what's this one here? 32 for NAB. So that's really impressive. You can see it's really started to turn around quite heavily there. All right, moving down a bit. Westpac Bank. See, remember I noted that Westpac Bank's earnings were not as impressive, but that was just my personal opinion from looking at the graphs. And I can see it on the net profit margin as well. It's still very impressive. Nobody's going to complain at a 22-odd% net profit margin, but it's not in the 30s like the other two, or close to it, right? Still very impressive nonetheless. All right. Macquarie. All right, so we've seen the stellar earnings with Macquarie, but believe it or not, Macquarie's net profit margin from what I'm seeing is about the 24-25% mark. All right, so it's not as high as CBA, but why has its share price done so well then? We'll solve that riddle next. All right, and then you've got ANZ, and again, not bad at 24-25, big turnaround there as well. Okay. So we looked at the net profit margins. Let's do this now. If I'm going to make for CBA around about 30 cents on the dollar, does it not make sense for me to sell more and more if I can? All right, so let's bring in the sales. Here we go. Here come the sales numbers. All right, so these are in millions, right? Was it in millions? I think these are in millions, but you can see over here, sales have fallen off a bit, not badly, but they haven't powered up. Don't underestimate what CBA can do. They're a blue chip bank. They will find new ways and new services to get more business. But at the moment, the sales have sort of fallen off slightly. But having said that, the net profit margin is more than made up for the drop in sales. So hence, I'll bring this up here. Hence the earnings, right? Hence the earnings, and that's why you're seeing a rise there in the earnings, because net profit margin is more than offsetting the drop in the sales, and the earnings look pretty good. All right. Ideally, what you want is you want CBA to continue powering on with its net profit margin and to grow its sales, because you watch out, those earnings will drive even harder. which in turn we would expect it to flow through into the share price. All right, NAB. Here we go. Here's NAB. Net profit margin, great. It's in the 30s. Sales, same as CBA. This is not bad. I'm just saying it's not growing at the moment. It's got a sort of holding in a sideways type pattern with a slight bias to the downside. Nonetheless, the uplift in the net profit margin is enough, despite the falling sales, to continue to drive the earnings. So we wait there to see what NAB will do to continue to grow its sales. So remember, one of the articles I brought up was it NAB? Who was it venturing into the buy now, pay later space? So the banks are innovative. They're looking at ways to continue to grow. All right, let's jump to the next one. Westpac Bank. Same deal. So sales is sort of sliding a bit as well. Net profit margin more than offsetting the slide in sales. So hence the earnings are holding up. All right. Next one here. Macquarie. Now look at Macquarie. Now, there's the answer to riddle. Remember I said I'd solve it for you, or at least help explain some of it. This is one of the reasons why Macquarie's share price, I believe, has continued to power on. Not only are they holding their net profit margin, so it's been holding pretty steady, it's because they're able to maintain their sales. So whatever they're doing well. Right, the millionaire factory, as they call them, is at Macquarie, the millionaire factory. They're doing something right there. All right, they are continuing to hold their sales steady. So of all the banks, I've been most impressed, at least with them being able to hold on to their sales volumes. So they're doing that well. So when you've got a good net profit margin and holding your sales steady, voila, look what happens to your earnings. Those earnings continue to power on. All right. And then there's ANZ, and we know some of the story behind ANZ. That they weren't able to write as many loans as they would like. They had a few issues in the back office that they're looking to resolve, and it does look like that's the case, because I am seeing just a little bit of a pop-up recently in the sales. But having said that, the overall picture has been one where the sales have come off slightly with the other banks we've seen, apart from Macquarie. All right. Okay. Two more things I'll bring up in terms of analyzing the banks, which is useful. Let's do it again. Let's graph it all. And I'm going to bring up this indicator called GRT. All right, so it's an indicator in VectorVest, GRT, earnings growth rate. And I'll just change the style, make this jump out a lot more. All right, GRT. This is the percent from which these banks in this example here are looking to grow their earnings. All right, so it's a VectorVest proprietary indicator. This is the growth rate being noted there, the forecast looking out for what the banks are likely to grow their earnings at. So if I look at the number here, right, 11%. Right, so 11% for CBA. If CBA can grow its earnings by 11% for the next 12 months, that bodes pretty well for the future price, most likely for CBA. If they continue to grow those earnings, because we've seen, if we bring it on again, that correlation between rising earnings, let's just change the style, make it jump out just a tad more for us here. We've seen that correlation between earnings and share price growth. So we're also now looking at the 12-month leading forecast on those earnings. All right, so here is the earnings, and it builds in a forecast, but this is the growth on those earnings. All right, NAB looks very good too. Look at that, nearly 20%. So is this because of the buy now, pay later space, or some of the other work they're doing? They look like they've got some pretty expansive growth opportunities bubbling away at the moment, and we're seeing that on the earnings, but very interesting to see that on the earnings growth rate that we're calculating at the moment. All right, Westpac Bank, not as strong, right? See, at 15 odd %, right? It's not as strong as NAB, but it's a little bit stronger, believe it or not, than CBA. All right, so that in terms of the outlook on their earnings. Okay. Macquarie Group, and again, it doesn't surprise me to see that pretty high up there as well from what we're seeing. All right, just shy of 20% there. And ANZ at 15%. So from a growth perspective, you know, I think Macquarie jumps out on a 12-month leading forecast on growth, and so too does NAB. All right. let me ask you this question. If you have a strong earnings growth rate outlook, driven by the growth on your earnings and the 12-month leading forecast on your earnings, how do you think that's going to stack up for your dividend safety? Do you think it's going to be good or bad for dividend safety? It's going to be good, right? So let me show you this. We have an additional indicator, the last one I'll introduce you today, and that is a dividend safety indicator in VectorVest. So it's on a scale of 0 to 99. Anything above 50 in Australia is great, and anything above 60 is exceptional. All right, so it's looking at the consistency and reliability of a company meeting or exceeding its dividend obligations. So from what I can see here, let's start at the top of the list. All right, so at the moment CBA, it's not bad. It's just a tad below 50. It's still a pretty rock solid dividend payer, as we've seen over the years. And as the earnings continue to power up, you watch this will hold steady and track up to. So I don't see an issue there. From what I'm seeing, NAB looks pretty exceptional there. It's just on the 60 there. So this one here seems to have a slight edge in terms of reliability over CBA currently, but not much. They're still both very good. All right, moving on a bit more here. Westpac Bank, just shy of that 50 mark. It's okay. It still looks pretty good, but just a little bit shy of the 50. And Macquarie Group, it's your standout. All right, it's about 65. Right, so in terms of reliability, Macquarie Group is the one that jumps out most at me for dividends in terms of reliability. But remember, it's a slightly lower dividend payer, and it's not fully franked. All right, so remember the yield here at 3.88. The others are between 5 and 6, so it is slightly lower, and you're not getting the franking credits. But having said that, its safety is the best we've seen so far of all the big banks, and it shouldn't surprise you based on that stellar earnings profile over the years. And then you've got ANZ coming in at around about what's that? Bang on 50. So it's a very good safety score. And those earnings powering on. So there you go. From a dividend safety perspective, Macquarie jumps out. From a price performance perspective over the last 5 to 10 years, Macquarie jumps out. So from a price and dividend safety perspective, Macquarie is jumping out. But from a yield perspective, in terms of the best yield at the moment, all right, so we had a look at that before, but let's just have a look here again. All right, ANZ is your higher yield at the moment, and it's still got a very good outlook at 50. These two here, Westpac and CommBank, just slightly below 50. I'm not overly concerned about those. They're still very, very good safety scores. Anything over 50 is very good, and 60 or above is exceptional. So Macquarie gets an exceptional safety rating on its dividends. And then in terms of dividend growth, all right, in terms of dividend growth, I did say that was my last one, but I'll throw in one extra because this is interesting. Dividend growth is what the company is looking to increase its dividends by. All right, so 9% on 3.52. All right, so 3.52 times 1.09. So that's what they're looking to do. So just lift it up slightly. Interesting enough, NAB here, its 12-month leading outlook on its growth is negative 9%. So although it's very strong at 4.4, it might fall back based on what we're seeing in the VectorVest system to potentially 4%. But the key driver of that will be earnings. If earnings start falling off, then you'd expect a slight tapering in the dividends. Time will tell. Westpac Bank is similar to NAB there at negative 10% there. Time will tell, but at the moment it is pretty high. So it wouldn't be the end of the world if it did drop to 4.5. I'm not saying it will. Nobody can tell you, and I can't give you advice on that. Please do speak to your advisor. I'm just looking at the numbers that we're crunching here in VectorVest, and it's showing there is just a slight offset on the dividend growth. Macquarie Group, again, the standout. Look at that, 13%. So it's looking to grow its dividends by 13%, but it is coming off a lower base relative to the others at 3.87. And ANZ is looking to grow its dividends on that pretty substantial 5.59 base. So from a dividend perspective, I'd have to give the prize, if I was to choose, to ANZ, because it's got the higher dividend, it's got the good safety record, and it's looking to grow its dividends. All right. And for those of you that are interested in, I keep saying the last one, but this is it's worth repeating this one here too. If you're worried about whether a company can meet its dividend obligations, what we do at VectorVest is we compare our earnings yield to our dividend yield. So an earnings yield is effectively what a company can pay right now, or at least on paper, compared to dividend yield in terms of what the company's going to pay you. So from an earnings perspective, earnings yield perspective, CommBank can effectively afford around about 4.89. And it's paying you out 3.52, so they've got a bit in the tank to go the further distance if required, and hence the growth rate there of 9%. So they've got a little bit up their sleeve. NAB, on the other hand, is looking to pay out 6.53, could pay out 6.53, but is looking to pay 4.4. Interestingly enough, they are looking potentially, based on dividend growth, to taper it back 9%, but they certainly got enough up their sleeve, so it might just be that they're being prudent. Westpac Bank here, 6.85, paying out 5, looking to throttle it back nonetheless, but they could effectively go almost 7%. Macquarie Group, 5.66, paying out 3.87. That's probably why they've got such a strong dividend safety record. They've got more than enough in the tank to meet 3.87. All right, and that's probably why they are looking to potentially increase it up another 13%. All right, and then ANZ, earnings yield of 8.58. Wow. That's a really high one there, and a yield of 5.59. So, yes, they have got that in the tank, and if you think that 5.59 is unrealistic, well, they have got that up their sleeve, and no surprises there to see that they can potentially look to lift it up a bit more. So I'd have to give ANZ the dividend prize, but I will give Macquarie Group the capital returns prize. In second place in terms of capital returns over the years, I'd have to hand it to Commonwealth Bank. And in terms of most improved, I'd probably give the award to Macquarie Bank for effectively just pipping ANZ to become our 4th largest bank in Australia. So fascinating analysis, is it not? So hope you got a lot out of it. The one for me that really fascinates me the most is that the benchmark, how we did the benchmark. So we changed it to being a performance graph, and we pulled in all the different benchmarks. That there was quite fascinating. So I know a lot of you hold CBA, but it'll just be interesting to see the battle of CBA and Macquarie Group over the months and weeks to follow. It certainly looks to be one of the most improved, and this is going to be a fascinating play out in the next couple of years, in my opinion, just to see how these two compete against each other in terms of returns. And then it's very interesting to see how ANZ continues to power on, because they certainly look to be stacking up from a dividend perspective, but you've got to ask yourself this question. You're going to get this slightly better dividend, but dividends on their own are not enough, right? I mean, sure, some of you might say, well, it doesn't matter. I'm going to hold on to my companies because I'm just interested in the dividends. But I bet it's fair to say that in the back of your mind, you're thinking, well, it'd be nice to have some capital growth too, right? Of course it would. So don't hold on to, and again, generally speaking, I can't give you personal advice, up to you to speak to your advisor, but from a general perspective, I have found it's not worth hanging on to company at all costs just for the dividends. There needs to be also capital growth. Why not have the best of both worlds? So get your dividends and have capital growth. And in terms of that, I'd have to say Macquarie Group is the one that jumps out to me. Sure, it's not as much. It's about 3.5 plus your 40% franking credits takes you up to about 4%. So it's not in the league of some of the others. It is a little bit less. It's between 2 to 3% less a year, but in terms of capital growth over the years, it's been significantly better than some of the other banks. So you more than compensated on the capital growth perspective. So, you've got to make that decision. What do you want? Do you want capital growth? Do you want income growth, or do you want a combo of the two? Are you happy to go with a slightly lower dividend in anticipation for slightly better capital growth? So these are all the sort of things that you can do. And with VectorVest, you've got the tools where you can dissect this to work out what you're after to perfection. All right. Well, with that said, thank you for your attendance today. I hope you got a lot out of it. It went on a little bit longer than my typical 20, 30 minutes, but because it's such an important topic, I wanted to put a little bit of extra time into there for you. So thank you for that. Sorry for the screen resolution issue at the start. Yeah, I hope you got a lot out of it. Let me know in the chat box. How did you find it? You enjoy the analysis? If you'd like, as always, if you're new to VectorVest, take out a trial if you'd like. I'll just bring the slide up just so you can see here. So I'll just move it on here. We've covered all this in the program. All right, so this one here, if you take it a trial, we'll give you up to 30 minutes training with one of our consultants. You get invited to our monthly online VectorVest Investment Club gatherings. We had our last one just this Saturday. Some amazing content was covered again. You get access to our weekly videos and essays and access to all of our portfolios that we track each day in the VectorVest system. So if you'd like to get hold of us, there's our toll-free number. You can email our support team, or you can reach out to me directly at russellmarkham@vectorvest.com. All right, at this point here, I think this is where I'll end the stream. So thank you again for coming along. I hope you got a lot out of it. You can get to watch the replay immediately on YouTube. I think it'll buffer and then you can go back and watch it from the start if you choose as well. All right, so I'll sign it off there. Thanks again, and we'll have another couple of really exciting talks coming up in the weeks to follow. All right, so just on there, this is not the end of it. Hot topics of interest. This is my second lot of hot topics. First lot was 5, and then we did another 5. Go look at us on YouTube. We've covered some amazing things like lithium, and we've spoken about travel stocks, and there's just been so many topics. So hop into our YouTube channel, VectorVest Australia. Google us up, YouTube, VectorVest Australia. Jump in there, you can have a look at all that stuff. And I need to get back to work to generate another hot topics of interest series. We'll generate another 5 exciting series talks. So I'm going to get my nose to the grindstone and dig out what's of interest out there, what's happening at the moment. We're just starting to see that market turn at the moment. So for our VectorVest subscribers, you know the bottom fishing strategies, sharpen up your tools with the bottom fishing strategies, because this may very well be the start of the turnaround. Again, I can't advise you, just generally speaking, seeing in the VectorVest system, keep your eyes peeled to market timing. Could be an exciting time coming up. All right. Until the next Hot Topics of Interest series, I'll chat to you then. We have a Q&A. Sorry, I've just got to turn my head. When's the next Q&A? 3 June on my big old-fashioned wall planner there on my wall. I like to write things down. 3 June. So if you want to take it a trial, you can come along to our VectorVest Australia Q&A. And to our subscribers, 3 June, 11 o'clock Sydney time equivalent. Note that down in your diary. That's when we next meet up. All right, I'll leave it there. Thanks again. Bye for now.